Campbell.
Thanks, Mr. Chairman. I'll stay on the same two topics I was on before. During 2008, we talked about too big to fail, but also too interconnected to fail. Dodd-Frank, and some of us have other ideas, tried to deal with that. Getting back to the European contagion, the risk to us is due to interconnectivity, I presume, if they had a disorderly, I believe, as you described it, a default of Greece or some other thing there. Is it international financial interconnectivity that puts us at risk? And if so, is there anything, obviously not in the short term, but that we ought to be thinking about that in the future? Because it obviously is frustrating you and frustrating up here as well, that here's this thing going on over which we have no control, but which could have major impact on us.
Well, that's part of the issue, and there are provisions in the financial reform that penalize interconnectivity in various ways and try to force more transparency about counterparties and those sorts of things. But I think beyond that, though, as we're seeing in the markets recently, just general pulling back, general risk aversion. I mean, we saw in 2008, we saw an enormous impact on emerging market economies that had very little direct connection to what was happening in the U.S. In the financial markets. So just the general fear and the general risk aversion would also be a very big effect, even between institutions that were not interconnected in that sense that you're talking about. So
the concern actually is almost more psychological, or as much psychological as it is purely economic?
It's psychological, but also in the sense that when there are losses occurring, and in a panic, people will not know what's safe, what's not safe, and their general reaction is just to pull back from everything.
Yeah, okay. Switching back to housing again, you mentioned about people being able to finance or refinance who are currently underwater in their houses. One of the issues with that, of course, is the regulatory system that financial institutions have to deal with, Basel II and so forth. Do you have any thoughts or suggestions along that line of how you could do that and still maintain a compliance with the international regulatory systems and so forth?
Yes, I think that could be done. If I'm mistaken, I'd be happy to look at it. The key here is if you're refinancing your own loan, one that you made, then you don't have to, in some sense, underwrite it from scratch. I mean, the credit risk is already yours. So the fact that it's an underwater loan, the refinance might actually make it more likely to pay off because the payments would be reduced. And maybe it could be combined with some kind of equity forgiveness, some principal forgiveness that could be worked off as well. I mean, there are various ways to structure that. So I'm not aware of any fundamental reason why a bank could not do that on its own loan.
Okay, thank you.
Thank you, Mr. Chairman. Thank you, Representative Campbell. We're joined by Representative Cummings.